change once you move from demo to real. And when you move to real, right, you have the fear of losing real money, and that can change your behavior, even if you have a solid strategy. Fear comes in once, even if you're down a little bit, you start closing your trade out, you start doubting yourself, and you start doubting your strategy as well. And in demo, it doesn't matter. You can hold a position indefinitely. You could have a drawdown of 50%, and in the demo, it means nothing at all. They're both useful if they match your strategy. And of course, they're quite different indicators. They do different things. RSI is relative strength index. It's measuring momentum, it's measuring overbought, oversold conditions. It's good for spotting reversals, potential reversals. It's good for spotting exhaustion. Normally you would combine it with another technical indicator. So it works well when you're looking at pullback or you're looking at range trading. And on the other hand, right, you have MACD, and MACD is more like a trend following system, right? So you have crossovers, you have the histogram growth, and you have the MACD line breaking resistance, breaking and crossing above or below the signal line. So essentially you use each of them in very different scenarios, right? You may also have a strategy which combines both of them, but it really depends on the strategy. So there's no best time frame, I would say. Only the best time frame for your strategy, for your lifestyle, and your psychology as well. So if you have scalping strategies, right, you really want very, very short time frames. You have intraday strategies, right? You may be looking at 15 minutes to 1 hour time frames. You have swing trading, 4 hours to 1 day. And then you may have other strategies, more longer term strategies, right? Where it's 1 day to 1 week. I think this depends on your risk reward, your strategy and your lifestyle. There's no universal number, but it depends on your time available. It also depends on the type of strategy you have. Some strategies need much closer eye, right? Because they're higher frequency, there's more stress, there's lower reward per trade. So they require you to sit right on top of what's going on. There will be other trading strategies like swing strategies, which require fewer trades and less time. So it really depends on these variables.